Most of the time we focus on US-China, but interestingly you point out in your research that actually the EU could hit back at the US much harder than China could.
It could hit back much harder. The EU, of course, is in disagreement. We know this internally. Apart from one issue, trade, there is large agreement on the issue of trade. The EU sees itself as developed as the US, as big as the US, and more specifically, there's no geostrategic rivalry between the US and the EU. We would expect not a broad-based retaliation, but a targeted retaliation, thinking ahead of the 2020 election, where can essentially the EU make it difficult for Mr. Trump and the Republicans to pick up seats by having targeted trade issues here and there across the US.
Look, Kallum, we could be in for what one report I read this morning, which was Car Wars Episode 1. 90 days of angst, another 90 days of angst on autos. When I look at global trade, I put it into the GTV library, synchronized slowdown, another 90 days of prevarication in auto wars. Would that really knock global growth? It would certainly knock European growth, wouldn't it?
It will certainly knock confidence. The global trade cycle drives the global economy. To a large extent, it drives global equity markets. We see this more as a bargaining chip from the US side rather than a ratcheting up of tensions in a major way. But we are currently in a very grey winter. Economic data is weak in Europe. It's a little mixed in the US. It's still soft in China. The last thing we need is a big trade war issue to knock the confidence out of global economies further. So I expect actually the economic news to get a little worse from here. The trade tensions tilt the risks a little further to the downside, but with a bit of luck, so long as this is just a bargaining chip and we get some progress by, say, summer, the economic data can start to improve, and so can the global economic risk environment.